Good afternoon, everyone. We'd like to welcome you to our presentation this afternoon on the newly passed One Big Beautiful Bill Act, also known as OBBBA. And yes, that is the official name of the new law, the One Big Beautiful Bill Act. It's a long sentence there, but it's great to be with you this afternoon. My name is Wayne Gilmore. I'm a shareholder in our firm's tax department and the firm's service and technology practice leader. Speaking with me this afternoon is one of my fellow shareholders, Ilyana Malinoff, who is our Director of Tax and also heads our international tax segment within the firm.
Good afternoon, everybody. Thank you so much for joining us today and spending the next 90 minutes listening to the One Big Beautiful Bill update. Hopefully you will find this informational and beneficial, as I'm sure you have already read many articles on the topic.
A little bit about the firm before we get started. Among the main services we provide to our clients are audit and assurance work, tax planning and compliance services, assisting clients with their accounting software and company accounting needs and advisory work on mergers and acquisitions, among other things, and then many other matters as well. We serve both domestic and international clients in the firm and are a member of HLB International, which is a global network of independent advisory and accounting firms, and currently the 8th largest network of international firms in the world. We keep up with ever-changing tax laws, such as what we're presenting on today, and focus on the opportunities to best serve our clients in their overall strategy. And there are going to be many opportunities in this OBBBA bill coming up here today that we'll talk to you about. Some quick housekeeping items before we get started. For any specific application of the new act, of course, please consult your HLB Gross Collins representative, as our discussion today will focus on the general changes to the tax law. Please submit your questions via the Q&A feature throughout the presentation. You'll see a box with a question mark in it on your top right, I believe. Feel free to utilize that and send us questions. We'll address the most common questions at the end of the presentation and reach out after the presentation as needed to other individual clients. To connect with a member of HLB Gross Collins, visit our website, hlbgrosscollins.com, or the QR code there, which we thank our technology people for. Feel free to utilize that as well. So now for the presentation and the timeline of the events of the bill. It was actually introduced in the House on May 20th. The House passed its version of the bill on May 22nd. The Senate then got a hold of it and amended the bill, and its amended version was passed on July the 1st. The House agreed to the Senate's amended version on July 3rd. You guys may have remembered that in the news. There was like a 24-hour overnight session of Congress that they got it done and got everything agreed upon. And President Trump signed the bill actually into law on the 4th of July. The bill is over 800 pages long. It's gargantuan. Implementation will require thousands of pages of regulations and other guidance. And still, we're waiting on some guidance on several topics to still come out here in the next week and upcoming months that will clarify some activity within the bill. Effective dates for various items within the bill include several different dates to be aware of. A lot of the changes will be retroactive. Some will start January 1st of this year, some when the bill was actually passed July 4th, and several after December 31st this year, and then after December 31st of next year. So at the end of the presentation, we have a couple tables, one for business, one for individuals. It lists out all of the different items with their effective dates, and they're permanent, or if they're not permanent, they will expire, and that table will reflect that as well. So on to now depreciation, and this is a very, very big part of the act. Bonus depreciation pre-act allows for 80% bonus depreciation, and this is now being changed with the passage of the new act for qualified property placed in service in 2023, phasing down by 20 percentage points each year until it sunsets after 2026. So currently, the bonus depreciation is at a 40% rate before this change was to happen. Since the bill has been enacted, it has permanently extended and modified the additional first-year depreciation deduction. And the permanently is a big word here. That's going to be in place from here on out until changed by congressional action in the future, which is not easy for things to happen to do that. The allowance increased to 100% of property acquired and placed in service on or after January 19th, 2025 of this year. And that's kind of an important date. If there's a written binding contract to acquire property in effect prior to January 29th, the date of the contract will govern the deduction able to be taken. So for example, if you entered into a contract to buy a piece of machinery on January the 5th, it's actually paid for after the January 19th date, you would have to revert back to the old law and have the 40% bonus versus the new 100% bonus due to that change in date when the contract was originally entered into. So that's something to pay attention to. Section 179, I know a lot of clients are also very familiar with. It allows for businesses to expense up to $1,160,000 of qualifying property with a phase-out threshold beginning at $2,890,000, index for inflation. Now, this is on the left-hand side of the equation here under the old law. The new enacted law is really helping clients out. It's increasing the maximum amount of taxpayer may expense under 179 to $2,500,000, and that increases the phase-out threshold amount to $4 million as well. So you can directly write off $2,500,000. Any purchases over that won't be able to be used for 179, can be used for bonus. But once you get to that 4 million figure, that's an important number. You start to phase out of what you can deduct for 179. So for our clients that buy a lot of fixed assets in a current year, that's a big number to pay attention to. Couple other words on the bonus and the 179. We want to pay attention to the state treatment on these. States do not always conform to the federal treatment, so there are often timing differences when deductions can be taken between the Fed and the state. So if there's an add back for Georgia, for example, it can cause Georgia tax to be due, and planning needs to be done to be able to have that be expected. And the correlation in the play between 179 and bonus is always very important. So that's another item to always look at. This next provision can really impact our manufacturing clients. In a quick summary, it can permit some qualified non-residential real property used in qualifying domestic U.S. production a 100% bonus depreciation deduction. In the past, anything related to real estate, either residential, non-residential, 27.5-year straight line mandatory, 39-year straight line mandatory for commercial has always had to have been capitalized under the depreciation rules. Well, now we actually have some ability for 100% bonus on some real estate depreciation items, and it's very, very powerful. So this is something to look at very closely for many industries, especially our M&D industry. So looking here at the left-hand side of our column, prior to the act, this absolutely did not exist. It was not applicable. Key provisions now, after it's been passed, the qualified production property is defined as any portion of non-residential real property used as an integral part of qualified manufacturing, agricultural or chemical production, refining of a qualified product resulting in substantial transformation. So if we're in these types of activities, 100% bonus depreciation for QPP can be taken, and it can be taken on property that began construction after January 19th, 2025, before January 1st, 2029. It's got a very long runway to it. The original qualified production use began with the taxpayer. That's very important. It's placed in service before January 1st, 2031, and is placed in service in the United States or the territories of the United States. So this would not apply to any foreign properties or foreign manufacturing locations, for example. It specifically excludes from qualified production property any portion of the building used for offices, administrative services, sales, research, software, engineering, lodging, or parking within the property. So Congress's intent here is to really focus on the portions of the building envelope that apply to the manufacturing or the alteration of the product. It also excludes from the qualified product mentioned above any food or beverage prepared in the same building as a retail establishment which it is sold in. In other words, restaurants are not going to qualify for this, unfortunately. Fast food restaurants, sit-down restaurants, franchisees, those restaurants of that nature. If there's a written binding contract to acquire the property, the date of the contract governs whether the acquisition date requirement is met. Once again, the contract is going to rule the roost here as far as our test on the dates. Businesses will have to make an election in order to take advantage of this. Businesses must plan to use the QPP in the same manner for at least 10 years. So this is a long-term undertaking. If accelerated depreciation is taken in early years and it's not used for 10 years, there's some recapture possibilities. So this is definitely a long-term play with this QPP property. And also, leased property owned by the taxpayer and used by a lessee does not qualify. So if I'm a owner of a piece of property, somebody in my property, my tenant is manufacturing, I cannot myself use that accelerated depreciation. I'm the lessor of the property.
So Wayne, would you say that we definitely have a planning opportunity ahead and a lot of questions, especially if we have a mixed use facility where maybe we conduct some manufacturing activity, but that's not the entire activity taking place?
Absolutely, Eliana. Yeah. And, cost segregation now may come into an extra, bit of play.
Even a bigger incentive to consider great documentation and considering cost segregation.
Absolutely. If we're segregating out our offices and parking areas and, which areas are designated for the manufacturing, that'll be very, very important. And document that.
Great. Moving on.
Yeah. Research and experimentation costs. This provision will greatly impact all of our clients engaging in R&D, especially our technology and software as a service clients. Under the old law, since 2022, any research and experimentation costs were required to be amortized over 5 years for domestic research and experimentation expenses, and also 15 years for foreign R&D costs. Under the new law, it's going to go back to the way it was before 2022. It's going to allow full expensing for domestic research and experimentation expenses from January 1st, 2025 on. Foreign R&E remains at a 15-year amortization. What this is going to do is going to provide small businesses, and small businesses are defined as less than $31 million in gross receipts over the past average 3-year period, with the option to elect this change retroactively back to 2022 through filing amended tax returns. We'll get into a little bit that here in a minute as well. All other businesses can reverse the impact by accelerating any remaining Section 174 deductions in 1 year, 2025, or 2 years, 2025 and 2026. So if we have a larger business whose revenues are over 31 million over the 3-year period, we don't have an opportunity to go back and expense the R&D cost through amended returns. However, what we can do is accelerate any remaining amortization that we have not taken in those prior years and deduct that either 100% in 2025 or elect to do it over 2 years in 2025 and 2026. And it may bring out some planning opportunities, and if we want to create NOLs or not create NOLs, things of that nature, why we might want to spread that over 2 years. Businesses with capitalized R&E expenses can benefit from immediate tax planning. What we want to do is evaluate the best route to apply retroactive change and receive refunds if possible for our small business clients, adjust 2025 and or 2026 estimated tax payments based on the changes in the expensing, and then capture additional cash flow. If we're going to be getting tax refunds back, it's going to greatly help cash flow within the businesses for operations. We created a little table here that summarizes very nicely based on the business size, average annual gross receipts in the first column. So if our business is $31 million or less average over the past 3 years, we have the opportunity to go back and amend returns for 2022 through 2024 as our retroactive option. There would be no accelerated deduction here because we're going back and taking all the expenses we should have taken or had the opportunity now to take over the prior 3 years. And the deadline to do this, an action is required within 1 year of the OBBB enactment. So 1 year from July 4th, if a company wants to go back and amend, they need to make sure they do it by that point in time here in January 4th, 2026. For most of our clients, we're going to be looking at this, if it's applicable, and beyond the amended returns here very quickly in order to get this rolling.
And I think you made a great point that this needs to be evaluated, and we can start this discussion now because some of just the practical considerations of factoring everything in is how many returns are we actually going to be amending?
Correct.
What is going to be the expected processing time for all of these returns until we actually have cash in hand? And would we achieve a similar result if we just take the easier path of the automatic 2025, 2026 compliance and essentially recompute, lower our projected estimated tax payments and pay ourselves the refund, for lack of a better word? That's not going to be a solution for everybody, but for a lot of our clients that I think continue to be profitable and have the ability to absorb these deductions in the current year,
Yep.
it may be the easier route.
Agreed.
So we should definitely look at it from both angles.
Agreed. Yeah. And for our pass-through entities too, some of our pass-through entities have, 50 or 100 partners. If we're going to be amending those and amending all the K1s, it's better to get that going sooner than later.
Yeah.
If it's material, those people may want to amend their individual returns as well.
And consider the BBA partnership amendment provisions, which are a different animal in and of itself. That whole procedure of getting those partnership returns corrected may just end up being more hassle than it's worth compared to a 2025 deduction.
Absolutely.
A lot to consider.
And with that, I would like to turn it over now to Ileana to discuss a few more business provisions.
Yeah, so as we said, a lot to consider, and the fun doesn't end with these 3 items, but I think Wayne did, thank you for doing an excellent job of highlighting, I think, probably the 3 most powerful provisions that were implemented in the bill in terms of trying to generate business activity, spending, and sort of continue to grow U.S. Manufacturing and business operations. So the provisions that we have here are also impactful and sort of interplay with the ones we discussed already. So the first thing we want to point out to you is to remind you of excess business loss limitations. This was a new concept that was introduced in the Tax Cuts and Jobs Act, and basically what this concept, what an excess business loss does is it limits the ability of a taxpayer with a flow-through business to deduct more than $500,000 of business losses for married filing jointly against other sources of income, such as W-2 income, investment income, and so on. So with this limitation, essentially, your pass-through losses become a net operating loss that is carried forward in the future years. So we may be generating on one side these really big bonus depreciation deductions, and we have to be careful about the timing of these deductions in case we cannot absorb the entire deduction in the current year, and what would the value of a future NOL look like for us. All of this would need to be modeled out because the big beautiful bill made excess business losses permanent addition to the tax code. They were previously set to sunset at the end of 2028. A taxpayer-friendly provision is the business interest expense limitation for our smaller clients under 31 million in gross receipts, as we discussed. This was not a very relevant or painful position for most of them because there was no limit on their interest expense deduction. However, for our larger clients, you're probably very familiar with the 30% limitation. Until originally, when this was introduced, the 30% limitation was calculated as 30% of adjusted taxable income, which most closely resembles EBITDA, earnings before interest, taxes, depreciation, and amortization. For a moment there, for the past few years, that calculation actually reverted to earnings before interest and taxes, and we can clearly see that becoming painful for some of our more leveraged clients as interest expense, the ability to deduct interest expense was limited. For years beginning now, essentially January 1st, 2025, effective for this tax year, the calculation reverts back to EBITDA. So for any clients with significant interest expense, what we're definitely going to look at is how this additional interest expense deduction changes their overall taxable position and their estimated tax payments and the interplay with all the rest of the deductions we just discussed. A significant change or a welcome change is that Section 199A is also made permanent in the tax code. Section 199A, I think, gave a lot of headache in the past 1 year. If you have attended any presentations related to the sunset of the Tax Cuts and Jobs Act, Section 199A, qualified business income, 20% deduction. It had multiple names, but it was extremely powerful and very much relied on by any business. There was a flow-through business because it was significantly reducing the top 37% rate for any qualified business income by allowing you this deduction. We're very happy that this is permanent. It takes away a lot of analysis on the table, a lot of possible C corporation conversions that we may have had to evaluate. And also, not only is it made permanent, but the phase outs are increased. So for taxpayers that are in a specified service trade or business, such as accountants, attorneys, doctors, etc., there will be more folks that would be able to actually take advantage of the 20% qualified business income deduction because of the increased phase out amount. The bill also creates a minimum $400 deduction, which I think is a nice touch, probably not as material as anything else we have talked to so far, but still a nice touch. A limitation that we want to bring into your attention, and it may be of limited use to some, is that under previous law, charitable deductions for corporations were limited to 10% of the corporation's taxable income. That rule remains, and it is further enhanced by the addition of a 1% floor. So not only can you deduct only 10% of charitable deductions if you're a traditional C corporation, but also the first 10%, the first 1% will be disallowed. So not really sure how that will affect charitable giving, but it will definitely have impact to more philanthropic corporations. A quick update here, touching on the state and local deduction. We'll be spending a lot of time talking about the state and local deduction when we shift into our individual provisions. But keeping business with business, we wanted to address the pass-through entity tax. The pass-through entity tax was a hot topic. It was created or sort of originated as a response to the individual state and local tax deduction that was introduced in 2018, which limited state and local taxes to $10,000. Probably everybody on this webinar is familiar with that. So as a result, 36 states and 1 locality implemented a mechanism, a pass-through entity tax mechanism that allowed businesses to pay tax at the entity level, and the IRS approved that strategy in Notice 2020-75, basically allowing an ordinary and necessary business deduction for any pass-through entity taxes if they're paid at the business level. So there was a lot of talk about the state and local tax being $75,000, the state and local tax cap being abolished, the state and local tax cap now being $40,000 for most filers. But we wanted to bring to your attention that the pass-through entity tax regime continues to be very significant, because we will show you in illustrations what a $40,000 state and local tax deduction possibly means to you. So if you haven't really evaluated the pass-through entity tax for your business, 2025 may be a great year for you to evaluate that all over again, having the certainty now of what our tax law is going to look like for the next few years. So the states are expected to react to the new law and to announce either their conformity or to modify certain pass-through entity tax language that they have in their statutes to ensure that their pass-through entity tax regimes continue to carry on as intended. And California was the first one that already extended its regime that was previously set to sunset at the end of 2025. Shifting gears a little bit, but staying in the state world, somewhat unexpectedly, the One Big Beautiful Bill Act decided to also expand the definition of solicitation of orders. So for those of you who are in the manufacturing, distribution, and supply chain space, we have probably had conversations already about what PL 86272 is, Public Law 86272, and how it impacts your company's state income tax position and whether or not your company has state income tax nexus and is required to pay state income tax in states other than its home state. So PL 86272 was really a taxpayer-friendly clause that stated that a state cannot tax a intercommerce business if they don't have any physical connection with the state, and it also carved out this term of solicitation of orders. So if your only connection to a state is simply solicitation of orders to an employee, it may be difficult for the state to assert nexus. The One Big Beautiful Bill goes further and expands the definition by saying that solicitation of orders means any business activity that facilitates the solicitation of orders, even if that activity may also serve some independently valuable business function apart from solicitation. So those are some very open-ended words, open to interpretation. We'll certainly be watching for additional guidance, but it certainly appears that this new definition will be helpful as we are entering a digital age of doing business, a digital age of communicating with our customers, and providing a more comprehensive service in addition to just shipping widgets across the country. So we will see how that develops. Section 1202 stock, shifting gears, that is going to be a very hot topic, I believe, for the next few years. This is an extremely taxpayer-friendly provision. And the one thing that we want to point out is that the new rules are really only applicable for stock issued after the passing of the bill, after July 4th, 2025. So if you're an existing business already, an existing qualified small business, then the previous rules apply to you. And the previous rules basically say that for stock issued after or acquired after September 27, 2010, you have an exclusion of 100% of the gain up to $10 million. And for stock acquired in earlier periods, the exclusion is either 50% or 75%, depending on the acquisition dates. So I think that there will be a lot of renowned interest and analysis in Section 1202 stock, Wayne. I think you agree. Yeah. Because the new rule is taxpayer friendly in three different ways. First and foremost, we now have a phased-in approach. So you may be able to get 50% exclusion if you hold the stock for 3 years instead of 5 previously. 75% exclusion if held for 4 years, and 100% exclusion if held for 5 or more years. In addition to that, we may see more entities being eligible to be classified as qualified small business stock, because the threshold for the value of the corporation's aggregate assets has been increased from 50 million to 75 million, and additionally the 75 million will be indexed for inflation. And finally, the applicable dollar limit for your possible gain exclusion has been increased from 10 million to 15 million. So those are, I would say, some pretty dramatic changes in increasing those thresholds.
Very much so, and the C Corp rates now have been made permanent low.
Exactly.
So now that's really not a big concern. A lot of people avoided 1202 setup to begin with because of the punitive C Corp rates and the double taxation on any dividends while they had to hold that stock for that time period. But now the rates are permanent low, and it's very advantageous.
It can be very advantageous, absolutely.
Right.
The Tax Cuts and Jobs Act also introduced qualified opportunity zones. There was a lot of talk back in 2017, 2018, when is the right time to invest in a qualified opportunity zone or a qualified opportunity fund to be able to defer gains from previous successful transactions. The qualified opportunity zones were really into effect only through December 31st, 2028. With the new bill, we now have a permanent qualified opportunity zone policy. There's additionally a rolling 10-year period of qualified opportunity zone designation that will begin in 2027. There are some new reporting requirements, disclosure requirements, eligibility requirements that hopefully will make the process both more transparent and streamlined. And additionally, the qualified opportunity zones have a new income recognition regime. So if you hold the stock for more than 5 years, you get to exclude 10% of the deferred gain, and you have to recognize 90% of the remaining gain at year 5. Additionally, the new bill retains the election to be able to step up the basis of your qualified opportunity zone property to its fair market value at year 10. And if you hold the property for 30 years, there's even further benefits. The bill also introduced a rural qualified opportunity zone, and the gain exclusion there, if you hold the investment for 5 years, is actually 30%. There's also a few other provisions related to rural zones and revitalization of rural areas that are not in the scope of this presentation, but we found them very interesting. So yes, if you're doing business in those areas and that's of interest to you, let us know and we can provide additional information about it. International tax provisions. So we have been spared international tax reform with this go round, maybe because the Tax Cuts and Jobs Act provided so much to considering the international tax landscape. We've listed here a few provisions, but we want to be cognizant that maybe not everybody on the call is interested in international tax or has a multinational or multi-tiered international structure. So a couple of things that we wanted to point out is first, the foreign derived intangible income. There was a special deduction of 37.5% of your foreign derived intangible income, which was very tax-friendly for companies that were exporting product or services out of the United States. That deduction was actually scheduled to decrease over time. What the One Big Beautiful Bill did is that it did permanently decrease the deduction to 33 1/3%. So if you think about your income stream from foreign derived income, this results in an effective tax rate not of 21%, but of 14% for federal tax purposes of that income. And you can see that there's some additional calculations, changes to the calculation. Together with the foreign derived intangible income, the bill also changed the calculation for global intangible low taxed income, or GILTI. We used to have a deduction equal to 50% of the net CFC tested income. That deduction is now decreased to 40%. We used to also be able to exclude certain part of income that was equal to 10% of the qualified business assets that were used in the foreign entities. That threshold is removed, essentially increasing the CFC net tested income that will be subject to tax in the United States. To offset that damage, though, we are able to use more of our foreign tax credits, 90% instead of 80%. So both of these provisions mathematically are driving towards an effective rate of 14% on foreign income, and that is the attempt for Congress for the United States to say that while the United States is not going to adopt the global minimum tax of 15% that the rest of the world is working towards, we already have an alternative regime that is pretty much getting us there, getting us to 14%. One final slide before we probably move into individuals and some of the more interesting provisions that you may have been hearing about. We wanted to remind you that the IRS has not forgotten about the employee retention credit. Unfortunately, that has become a challenge for some clients to deal with, and the IRS is continuing its enforcement actions against bad actors. So under the new bill, the IRS is prohibited from making any payments on Q3 and Q4 2021 claims. So if you have any of these still in the works, it may be worthwhile to inquire and confirm what the status of that is before they're considered non-collectible. And the bill also provides some enhanced childcare credits for employer-provided childcare, if this is a provision that your organization supports. The bill also provides enhanced paid family and medical leave credit. The bill enhances the tip credit, and we'll talk about tips a little bit later. The tip credit was typically applicable to the food and beverage industry and was a credit for any FICA that was paid on tips that were actually being reported as taxable income. So the One Big Beautiful Bill includes beauty services now in the calculation of the tip credit. What the bill didn't get to was the work opportunity credit. So if the work opportunity credit is not addressed in any of the upcoming reconciliation bills, it will expire by the end of December 31st, 2025. Oh, there's more. Information returns. So I think that I'll date myself a little bit, but I've been an accountant for the last 20 years, and the threshold for Form 1099 has always been $600, always, no matter what. And I think that every January, everybody was dreading collecting the information and filing those 1099s for payments made in the ordinary course or trade or business. Finally, we have an increase, and for payments made during 2026, the threshold is increased to $2,000, and then it's going to be adjusted for inflation going forward. So while you have to check every year what the inflation adjusted amount is, maybe this will reduce the number of 1099s you have to file in half.
Yes.
There are some revisions to the 1099K rules for reported income that is handled through payment organizations. So maybe many of you are on the recipient end of those 1099Ks. So under the new rules, you will be receiving a 1099K for payments that are processed by a third-party settlement organization only if they are over $20,000 and over 200 transactions. The excise tax was really talked about in the news, depending on which news you listen to, I guess. There was talk about a 3.5% excise tax, 6 or 8% excise tax, targeting all of the payments that were leaving the United States, going to different foreign recipients. I think that things were dialed down and dialed back significantly, and what actually made it in the bill is a new 1% excise tax on remittance transfers by individuals to foreign recipients. So this tax applies to cash, money orders, cashier's checks, or similar payment types like Western Union. This does not apply to your ACH payments or your bank wires that are made in the regular course of business. The tax will be effective January 1st, 2026. It will be paid by the sender of the money, and it will be collected at the time at which the Western Union transfer is made and remitted to the government at that time. So we hope that this new tax will not have significant disruptions to the way you do business and you operate in a financial environment in different bank transfers. A quick slide on energy. Energy was not necessarily a clear winner in this bill, so you can see a list here on various different credits that have been around for a while or were introduced a couple of years ago by the Inflation Reduction Act. And then you can see with the OBBBA that most of these credits are scheduled to sunset or to terminate over time as the current projects wrap up. So in the interest of time, we're not going to cover any of these, but you will have it in the slides if it affects you. And I will turn it over to Wayne to go over various individual provisions now.
Wonderful. Thanks, Ileana. That wraps up our business side of the equation, and a lot of activity, a lot of planning opportunity there. So now moving on to the individual side. This will affect everybody, in their 1040s, and hopefully also provide some good planning opportunity. But individual income tax rates, pre-OBBBA, 7 tax brackets from 10% to 37%. Bracket thresholds are adjusted annually for inflation. They sunset after 2025 to the maximum rate of 39.6. So we were in for one of the biggest tax increases in the history of the United States here at the end of 2025 if this had not passed. So this is good for individuals. So under the enacted new act that makes the Tax Cuts and Jobs Act rates permanent, all brackets continue to be indexed for inflation after 2025. Also adds an additional year of inflation adjustment to the end of the 10% and 12% brackets, where the 22% bracket begins. So that'll help out those lower income folks. The standard deduction under the pre-act increase, the standard deduction expires after 2025, reverts to lower pre-Tax Cuts and Jobs Act levels. You guys may have remembered the standard deduction really increased to the point where a lot of people weren't even itemizing anymore. It wasn't worth doing the analysis. It was so large. Well, that has been permanently increased with the new act, effective as of January 1st, 2025. We're looking at $15,750 for single and married separate. Had a household $23,625, and married filing joint $31,500. So that's still a pretty big number to get over in order to itemize here in 2025. Personal exemptions were suspended 18 through 25. They actually went away, and that permanently terminates that deduction as well for personal exemptions under the new enacted act. AMT, higher exemption and phase out thresholds, Tax Cuts and Jobs Act set to expire after 2025. We keep hoping AMT someday will kind of go away and phase out for individuals too, but it still has not.
Not this year, not with this bill.
That's right. Under the new act, there's a higher exemption and phase out thresholds. They're now permanent under the new act for AMT, and it increases the phase out rate to 50% versus 25% under the current law. So beneficial there to an extent. On the child tax credits, pre-act $2,000 per child under the Tax Cuts and Jobs Act, and that was set to revert to $1,000 after this year. Under the new act, permanent increase, they actually raised it up to $2,200 per child, with $1,400 refundable, subject to inflation adjustments. So now, if your tax is zero, you can get a refundable portion of that child tax credit. Refundable portion for 2025 actually now is $1,700. That was $1,400 for 2024 year. 25 has been indexed for inflation up to $1,700. Also, permanent increases to the phase-out thresholds of $200,000 for single and $400,000 for married filing joint. So many more taxpayers with higher incomes are going to be able to utilize the child tax credit. And important to point out, the child tax credit applies to children 17 and under that are your dependents and living in your homestead. Other dependent credit provides non-refundable credits of $500 per qualifying dependent who does not qualify for the child tax credit. And often there's cases where elderly parents are living in the household, don't have any income. Older children, we have college age students, if they're under age 24 and over age 17, if they're going to college full-time or actually part-time, we're able to take a $500 credit for them. So under the new act, the $500 credit has been made permanent. The new requirement is the dependent be a resident of the United States, and there is no inflation adjustment on this going forward. So the $500 will remain for the next several years on that. We have had some clients take advantage of the adoption credit. In the past, if there was no tax liability and there were a lot of adoption expenses paid, qualifying for the credit, it would have to have been carried forward. It was non-refundable. Well, now in the new act, $5,000 of that can be refundable, which will help many families. And that is inflation adjusted as well. So that $5,000 will go up over the next several years. This will affect a lot of people on the call here today, individual provisions changing or not changing under itemized deductions on Schedule A. The mortgage interest deduction, everybody's probably pretty familiar with, but we can utilize $750,000 of acquisition indebtedness to take mortgage interest deduction on under the pre-law, expires after 2025. And that, of course, is when you buy a home and you can take up to a $750,000 mortgage out, have it be fully deductible, the interest portion. If it's over that, it would start to be limited. Well, the new law makes that $750,000 permanent. So no big win there, but if anybody's paying PMI, mortgage insurance premiums, those would also be a deduction under interest taken over and above the $750,000 mortgage interest acquisition indebtedness figure. So there's a little bit of benefit there. Home equity debt is under the old law and made permanent under the new law going to be rolled into the 750. Interest on home equity debt is not deductible if the loan proceeds were used to buy, build, or substantially improve the taxpayer's home that secures the loan. This disallowance applies through 2025. Previously, now it's been made permanent. Back in the old days, 10 years ago, over and above the mortgage interest deduction, there was a possibility to deduct interest on up to $100,000 of home equity indebtedness if it applied. That does not count any longer. That's all part of that 750 now as well going forward. Casualty loss deductions. Unfortunately, we've had a lot of clients with Florida real estate, for example, have been hit by several hurricanes over the last several years. That's been in the past limited to federally declared disasters through 2025. They've kind of expanded on that a little bit under the new law. It's federally declared disasters have been made permanent, but it also expands the definition to include certain state declared disasters. So, with the flooding that has occurred, sometimes the states will declare it. Not necessarily all the areas will be declared by the federal government. This is now going to be able to also benefit you on your federal tax returns as a casualty loss deduction. Hopefully none of us have to worry about that. Miscellaneous itemized deductions were suspended 2018 through 2025, reinstated in 2026. These are items such as unreimbursed employee expenses, the cost for legal and professional fees for estate planning, tax return preparation fees. Those were suspended prior. The new law permanently terminates deductions and removes unreimbursed employee expenses for eligible educators from the list of miscellaneous itemized as well. I believe the educators, Ileana, still have that $300 above the line deduction that they can take.
Yeah.
If the teacher has out-of-pocket expenses for her classroom, his classroom, that can still be utilized on the tax return.
Yeah.
Yeah.
At least for 2025, I believe in 2026, while this is not going to be a miscellaneous itemized deduction, the educator expenses will become an itemized deduction. So effectively, if you're an educator who is using the standard deduction, even that little benefit of $300 is going to be removed, and it would only be applicable if you begin itemizing.
Right. Okay. Next down, the Pease limitation, and Pease was actually a congressman that got this passed several years ago, but limitation on itemized deductions. So this was suspended in 2018 through 25. It was basically a reduction of itemized deductions for high income taxpayers. Now under the new law is consistent. It has permanently removed the Section 68 Pease limitation on itemized deductions. And replaces it with a new overall limitation on the tax benefit of itemized deductions. So starting in 2026, for taxpayers within the top 37% bracket, this is going to apply. And this is really some congressmen at work here, but
who didn't want to be named, Wayne. They did
right.
not want their name associated with this.
But the amount of itemized deductions otherwise allowable would be reduced by 2/37, if you guys can believe that, of the lesser of the amount of the itemized deductions or the amount of the taxpayer's taxable income that exceeds the start of the 37% tax bracket. What all this is getting down to is they don't want anybody to be having more than a 35 cent on the dollar deduction for itemized deductions. So that 2/37 represents that reduction when you do the math. That's the best way to explain that. So, and we've got some examples coming up here showing various, not only the itemized deductions, but SALT limitation and charitable contributions and how that can impact some individual situations. So we'll show that here in a minute. Moving expense deduction, suspended 2018 through 25, except for the armed forces. Back in the day, 10 years ago, if you were moving as a result of changing your place of employment or career and a certain mileage limit you'd have to travel, those were all deductible, and it was a pretty healthy deduction. Well, under the Tax Cuts and Jobs Act, they eliminated that, and they have now permanently terminated that as well under the new act, except for armed forces. Armed forces can still take that. For us gamblers out there, wagering losses limited to itemized deduction based on the amount of winnings through 2025. That has been amended to it's going to limit losses from wagering transactions to 90% of the amount of such losses only to the extent of winnings. So that's kind of self-explanatory. Yeah. So if anybody's out there and you have a big win in the Georgia lottery, you may have some expenses related to that. Let us know what those are. We might be able to take part of them on your tax return.
Overall, I think everything is consistent with the analysis that we did when the Tax Cuts and Jobs Act came along, where we are enjoying the slightly lower rates, but definitely a broader base in terms of different deductions that would have to be substantiated and
correct
documented.
Yeah, exactly. Okay, some provisions here on charitable contributions on the left-hand side here. So cash charitable deduction for non-itemizers. Prior to the law change, if you're not itemizing deductions, you're not going to have any deduction available for any charity. Enacted under the new act, it's going to create a charitable contribution deduction of $1,000 for single filers or $2,000 for married joint for certain charitable contributions. So don't necessarily have to file that Schedule A. We'll be able to take $1,000 or $2,000 for charity. The deduction is permanent. It starts after 2025 though, so it won't apply to this year, but will in 2026.
And it's for cash only, correct? Not your Goodwill.
Very good point. So if you're taking furniture and clothing over to Goodwill, that's not going to apply to this. It has to be cash contribution. Cash charitable deductions for individuals who do itemize, who are filing Schedule A. Under the pre-act, taxpayers who itemize can deduct a portion of their qualified charitable contributions subject to a specified limitation based on the type of contribution. So basically that means there's, like a 30% charity, which is you can deduct up to 30% of your adjusted gross income on your return. There are other charities known as 60% charities. You can deduct up to 60% of your adjusted gross income. A donor fund, for example, where people are putting in stocks into a donor fund would be an example of a 30% charity. So that's how the old regime would work. Under the new tax law, the limits on charitable deduction for taxpayers who itemize by providing a deduction only for charitable contributions to the extent that they exceed 0.5% of the taxpayer's contribution base. Now that contribution base is made up of adjusted gross income before any net operating loss carryback or charitable contributions. So basically we're taking our adjusted gross income, multiplying by 0.5% to come to a floor, if you will, before those are able to be deducted. Any disallowed portion, we'll be able to carry those forward for a 5-year period if we don't get to use those all in the current year under the new law. Okay, so a couple examples here we'll go through that kind of shows these limitations and how they might affect the taxpayer. So scenario number 1 here, in 2026, a couple living in a state with a 7% tax rate has a combined annual income of $505,000 and pays $35,000 in state income taxes, $15,000 in property taxes, and $25,000 in mortgage interest. The total state and local tax payments amount to $50,000, which is our state tax of $35,000 and our property tax on our home, for example, of $15,000. So in this case, we kind of run through the math. Our adjusted gross income, our mortgage interest deduction, we see a total $50,000 state and local taxes paid. Our new cap limits us to $40,000 on those amounts. There is a 30% phase out of that cap based on our limitations. So our state and local deduction allowed would be $38,500. So depending on income levels, we're not automatically getting the $40,000. Our cash charitable contributions are $12,000. We now have our new charitable floor disallowed effective in 2026, and that's multiplied by $505,000. Our adjusted gross income multiplied by 0.5%. I don't want to get too deep in the math here, but that's a 25-25 disallowance. So you can see the federal taxes there are slightly higher based on those two phase outs that occur in that example.
Yeah, we wanted to highlight, I guess, 3 different haircuts that appear in a very straightforward example that maybe some of you would identify with, even though this is not Georgia because our tax rate is lower than 7%. But first we have a limitation where the 50,000 becomes 40. Then
Yep.
we have another limitation where the 40,000 becomes 38.5. And then we have a still other limitation where we thought we contributed 12,000, but we really contributed less than 10 for tax purposes, right?
Correct,
So you can
correct.
sort of see the leakage of deductions here that is effectively increasing the tax rate.
Exactly. All right, so the state and local tax cap. Pre-law, we were only allowed to take $10,000 for state income taxes in Georgia, for example, and property taxes paid on your home and other real estate. Under the new law, the SALT provision retroactively increases the individual limit. So we're going to benefit from this in 2025. It's going to go from 10,000 to 40,000. It's indexed for inflation over the next few years. So 2026, 40,400. 27 through 29, it goes up by 1% each year after that. Unfortunately, this is not permanent. It's going to revert back to $10,000 in 2030, but hopefully by then something else will have been changed by Congress. And if California and New York have their say in it, it definitely will be changed. The deduction, another limitation here, is also subject to a 30% phase out. This is state and local taxes for modified adjusted gross income greater than 500,000 in 2025. 505 and 26 and similar 1% increases after, but the deduction will never reduce below $10,000. So that 500,000 threshold figure is kind of our starting point where we begin to get dinged on this deduction in our tax returns. And of course, as Ileana pointed out earlier, with pass-through entity tax, there is no SALT limitation for, S corporations, partnerships, and so forth, if the tax is paid in those entities.
Well, before we dive into the example, I think one clarity we wanted to put in here is that there was a lot of talk about leaving the pass-through entity deduction intact in general as a computation, but imposing a limitation if you're engaged in a specified service, trade, or business,
Right.
which effectively would have caused the pass-through entity tax benefit to be eliminated for a large part of the pass-through entity business owners kind of behaving the same way that the state and local cap on Schedule A would be.
Right.
So that, luckily for us, did not pass.
Yes, good news.
Yes.
All right, so our third example here, couple living in a state with 7% tax rate has a combined annual income of 505 and pays 35,000 in state income taxes, 15 in property taxes, and 25,000 of mortgage interest. Total SALT payments again are $50,000. So this kind of goes through the math once again here, kind of just laying out the phase outs for the SALT, the charitable contributions. So once again, our federal tax is a little bit higher based on our limits. This really starts to point out where things kind of fall off a cliff as far as calculations and how things can be disallowed. In this example, couple living in a state with a 7% tax rate has a combined annual income of 505, pays 35,000 in state taxes, 15 in property taxes, and 25,000 in mortgage interest. The total SALT payments amount to $50,000. We're going to compare that left column to another couple making $600,000 and paying $42,000 in income tax.
Or the same couple.
Same couple with, yeah.
With
Exactly.
large bonuses, because that may be you.
We get a bonus here. So under the left side, that's very similar to our calculation we had in the prior slide. I'm just working through with a couple of minor adjustments there. Well, on the right side here, the big item to point out for 2025 is that 30% phase out on number 2 for the SALT cap. What happens is we have to take 30% of our amount of our income over that $500,000 threshold. So 600,000 less 500, that's 100. That translates into $30,000 disallowed. We are allowed $10,000 based on this scenario. So working our way through the math, you can see 133 is due versus the $90,000. Now had an increase in income. We were, of 95,000. We were expecting an increase in tax, and based on the itemized deduction rates, we were expecting about 35%. Well, the actual increase, as you can see, is 45.68%. So this,
I think, maybe they didn't carry out, or maybe they intentionally did carry out that phase out with the 30%, but that certainly does not seem quite fair. Definitely not the definition of a fair tax, where your additional bonus ends up being, 45% tax bracket, particularly because you just happen to have deductions. So
exactly.
A lot of planning here that is not even, I feel like, the good type of planning, right? Where you have to be planning, should I have the charitable deductions this year or next year? Should I pay my state and local tax this year or next year, right? That I can avoid that unexpected consequence, essentially, of causing my additional income to be taxed at such a high rate. And imagine if you are a pass-through entity tax owner, you don't really control what you get on your K-1.
That's right.
Yet so many limitations are based on your adjusted gross income, which is affected by your K-1.
That's right. So, a year end, we kind of want to take an inventory of where we're at and plug the numbers in and see what we can do.
And a third example to make your heads hurt some more is where we introduce the final nail, right? The 237th rule.
Yeah. So in this case, we have our two columns like we did in the prior slide, but we're introducing a column number 3. We're going to compare a third couple making $785,000 this year and paying $55,000 in state tax. Now for that 237th rule, Eliana talked about, that's a limitation on itemized deductions, and that one of the measuring points on that begins where the highest tax bracket at 37% begins, which is 751.6.
Right.
So going through the numbers, they're similar to all of our other ones, but the 237th rule kicks in, also that 1805 on the right-hand side there. And just to summarize at the bottom, we were paying 45.68% in the number 2 in additional tax. Well, in number 3, we're still paying additional tax, 38.91%. We're kind of still expecting 35. So at this level, it's also kicking in pretty good here.
Yeah. I mean, you can see the more money you make, you have more itemized deductions, but you get to claim less of them. I think that's the moral of the story here.
Right.
Of how the deductions will work going forward.
Right.
Maybe we can shift into some more cheerful news now.
Yeah, we'll turn it back over to Ileana for some overtime.
Yeah, so we're going to run through the big major campaign promises that were in the news. So the first one was no tax on overtime. I think as we were listening to those promises as practitioners, we were kind of wondering how is that actually going to be carried out and executed? Who is actually going to police the reporting associated with overtime? Is it going to be the DOL who is already looking at that? Is it going to be the IRS? We don't really have the answer to the question. It appears that it's going to be a mix, but the bill delivered. Obviously, in the past, overtime was taxable income, and I think that to a certain extent, overtime will continue to remain taxable income. It just depends, as everything else that we talked about, on how much overtime you have and how much money do you make in total. So the new bill allows up to $12,500 for single or $25,000 for married filing jointly as a deduction for qualified overtime compensation. So this is self-reported on the individual income tax return. So in order to be able to claim that above the line deduction as an individual, there would need to be information provided on your W-2s. And because this is effective for tax year 2025, which is now, Congress has tasked the IRS with providing guidance on this by October, so that payroll companies and other providers, as well as the government itself, can actually adjust their systems to be able to receive this information and properly account for overtime payments, although there is going to be some transitional relief for tax year 2025 in case we don't get it quite right. So in a nutshell, if you are getting paid overtime, your overtime will be specifically reported on the tax return on your W-2. You can expect that there will be clarifications where the overtime calculations will be based only on the overtime portion. In other words, if you're getting paid time and a half for certain work, only the half will actually be overtime, not the one time. There is actually going to be most likely regulations that target any kind of abuse or witty loophole searching to reclassify maybe standard rates into overtime rates and vice versa. But the overall merit filing joint will be able to deduct $25,000 with a phase out that begins at $150,000 for single taxpayers and $300,000 for merit filing jointly. The deduction is not available if you choose the merit filing separate status. And I think it's important to point that this is a joint attribute, which means that you may have a couple with only one spouse earning income, and they would still be able to claim a $25,000 deduction if there is sufficient amount of overtime. The deduction is temporary. It starts in 2025, and it's set to expire in 2028.
So it sounds like the onus is really going to be on the companies too, in order to break this stuff out.
Yeah, I think so.
Yeah.
It will be
Maybe
a challenge for year-end payroll for sure.
Right.
The other campaign promise was no tax on tips, and this deduction behaves very similarly with another up to $25,000 deduction on qualified tips received for certain occupations. I think the catch here is what are the certain occupations that will be considered as eligible for this type of tip pay and deduction. And so Treasury has to define those occupations by October 2nd. And I think in our discussion of the tip credit, we can definitely rely on that. We can certainly expect restaurants, bartenders, beauty services to be part of that deduction. But as we have all experienced in our day-to-day life, with the increase of tip culture, you're probably tipping more places than just those three that we mentioned. So it will be interesting to see what will be announced in the occupations. Specified service trade or businesses are also specifically excluded, so don't expect HOB Gross Collins to say, that our engagement letters will change, and if you're satisfied with your service, you can go ahead and tip us. So again, that is not applicable. That's my attempt at a joke, and we are joking at our expense, but we have already had several conversations about discretionary compensation and how much of that and how can be reclassified as a tip to be able to take the $25,000 deduction. So certainly people are starting to think outside the lines. Similar limitations apply with the $150,000 phase out beginning for single taxpayers and $300,000 for merit filing joint. But this is, again, an above the line deduction. You're not required to itemize. This is a separate calculation that will hopefully be beneficial to some of you. The third campaign promise, the no tax on retirement income, or I'm not sure how exactly it was worded, no tax on Social Security. So we just want to be clear that there's nothing in the bill that says no tax on Social Security. Instead, what the bill provides is enhanced deduction for seniors. So the seniors already have an enhanced standard deduction. Now we are actually going to have a bonus $6,000 deduction for each senior. So if you're a married couple and both spouses are over the age of 65, you will be able to claim $12,000. And then this deduction begins to phase out for single taxpayers with AGI over 75,000 and married taxpayers with AGI over 150,000. Again, not available for married filing separate. Again, above the line deduction, so you can actually add it on to your standard deduction, or you can add it on to your itemized deductions. And the formula for calculating how much of your Social Security is taxable remains the same. Definitely no tax on Social Security. The last campaign promised to support the American automotive industry, and also the rising interest rate environment, I think, was to allow a deduction for personal interest. Personal interest historically has never been deductible, but here we have the first exception where you are allowed to deduct up to $10,000 of interest on any new car loans. This deduction comes with a variety of requirements, so it remains to be seen how many of our clients and taxpayers are actually able to benefit significantly from this deduction. Most car loans do not have $10,000 of interest in a year, according to my math, but maybe some do. The vehicle needs to be a U.S. assembled vehicle, and the IRS will probably work with manufacturers to determine what that list is going to look like. At the time of filing of your tax return, you'll be required to submit your VIN, so there will be some sort of automatic qualification and double check to claim this deduction, similar to the electric vehicle credits. In addition to that, there will be some onus put on lenders because they are going to have to start providing you forms similar, to the 1098 form for mortgage interest that gives you all of this information as well to be able to claim the deduction. Like the other three deductions, this is an above the line deduction, so this is in addition to your itemized deductions or in addition to your standard deduction. And it is also a temporary deduction set to expire at the end of 2028. So you can see that there's similarity in these four deductions, which were promised and are included in the bill, but they have a relatively short shelf life.
Real quick, I think it is very important to do the research up front to make sure, kind of like with the EVs and the EV credits, not all those all the time qualified. Even, clients would think, what's electric? Let me just go out and get it.
Yeah.
We need to make sure it qualifies.
Yeah, and definitely question what you're being told when you're purchasing a vehicle. And right. I'm sure that the IRS is going to have a landing page with frequently asked questions soon, because this is one of those things where there's going to be multiple sales tactics, and the small font on the bottom saying consult your tax advisor.
Yep.
After you have driven the car off the lot.
That's right. That's right.
There was a lot of focus on education, both positive and negative, in the bill. The bill, as you all know, is not just a tax bill. There's a lot of things that were covered in the bill. So we are going to cover just a few provisions related to education and savings. The first one is the general rule for discharge of indebtedness from student loans. So typically when a loan is discharged, the individual would receive cancellation of indebtedness income that is reported and taxable. However, the One Big Beautiful Bill made permanent the Tax Cuts and Jobs provision that if an individual is discharged from student loan indebtedness due to death or disability, that income is actually not going to be taxable. What the bill also added is a requirement that the taxpayer does have a valid U.S. Social Security number in order to be able to claim that exclusion. The bill also made permanent the program assistance under Section 127, which allowed for an employer to provide sort of employer-sponsored payments for educational assistance programs under Section 127. So the maximum exclusion of that amount is $5,250, and the law currently allows for qualified student loan payments to be part of that sort of qualified educational payment, not just new educational programs or assistance. This was set to expire after 2025 and is now being made permanent. So we want to take the opportunity to remind you that this needs to be a truly employer's educational assistance program, and if you as an employer want to put such a program in place, you cannot direct the employee to choose between tuition payments or other types of payments, such as bonuses that they're due. You obviously cannot discriminate. That's very typical for the different employee-assisted programs. You cannot discriminate in favor of highly compensated employees and their relatives, or relatives to owners. And if you are choosing to use this program for employee student loan assistance, the employee needs to be able to substantiate that the loan payments have been made, rather than just to receive that non-taxable educational assistance as a bonus. There are changes to the 529 qualified plans. We have the Tax Cuts and Jobs Act allowed $10,000 of 529 plans to be used for K through 12 tuition, and that continues on with the One Big Beautiful Bill, and it also adds on homeschool expenses and additional post-secondary credentialing expenses, such as if you want to go into some sort of a technical program or a licensing program, such as a CPA. That would also be considered an educational expense that can be paid with a 529 plan. And finally, what we wanted to talk for a little bit is the Trump accounts. The Trump accounts were both promised, but also left open-ended. So one specific, the bill actually does say that no contributions can be made into the Trump accounts for 12 months after the date of the enactment of the bill. I think that is just to provide time so that additional regulations and guidance can be issued surrounding the Trump account. But the Trump accounts will essentially behave like IRA accounts, individual retirement accounts, for the benefit of individuals under the age of 18. So you'd basically be able to contribute in a Trump account without the child having any earned income, right? Because earned income was the requirement of being able to contribute in an IRA.
Right.
So the contributions in the Trump accounts will be non-deductible, but they will grow, the funds will grow tax-free in the account until they're there. You will be able to make contributions up to $5,000 annually for every calendar year up until the individual turns 18, the beneficiary turns 18. And then you can start distributions at the time that the beneficiary turns 18 as well. When you want to set up a Trump account, it would have to be designated as such at the setup, so we cannot really be recharacterizing or rolling over any other accounts and funds. At least that's what we know right now. And then Treasury, in its discretion, will be able to set up Trump accounts for individuals that it identifies as eligible and for which no Trump accounts have already been established. And then Treasury is also expected to make a $1,000 contribution for each qualifying child born after 2024 and before 2029. So I'm sure that the news are going to keep us abreast when these accounts continue to develop and more guidance is issued, and when the first contribution is made in somebody's account. They'll be like the New Year's baby, you know, the first baby that gets a Trump account contribution.
Right. It's got potential to be very powerful. Grandparents looking for ways to help their grandchildren, and $5,000 a year until they're 18, from age 2 to 18, for example. If that's the way it ends up working out, it could be huge.
It'll be very interesting to see how it plays already with the different other giving strategies that we have, whether or not it will be part of the annual limit. Can we have only one account per child, right? What are we going to do if the beneficiary doesn't want to take any money? How does it transfer in the estate? Can you give the account to somebody else? All of these questions.
That's right.
The answers remain to be seen
Yep.
for our higher net worth clients. That brings us to a quick recap on estate and gift. I think that estate and gift had its moment with the sunset for the past couple of years, and so many of our clients embarked on estate and gift planning that was so needed, right? Because we were all facing the sunset of the $5 million, the $13.61 million to $5 million at the end of 2025. That issue has now been resolved, even though we were not able to abolish the estate tax. At least we have $15 million permanent and indexed for inflation going forward. So I'm sure that there's still a lot of estate plans that need to be finalized, and please continue to work on them because, it was good work that started. It would still be needed, but at least we have a little bit more certainty and we don't have a clock ticking anymore. That's right. Until the end of the year.
That's the key, permanent.
Permanent, that's
the key word, right.
And index for inflation, right? And the law of large numbers works here, and the adjustment definitely gets to be bigger and bigger every year.
Yes.
So with that, the next two slides are just a summary of the business provisions that we covered and the individual provisions that we covered. We wanna leave a little bit of time for questions and discussion if you have any questions. But here we can see the timeline of the provisions we discussed on this webinar, their effective date, and whether the provisions have been made permanent or temporary. So if you'd like to know more about any one of these provisions, both individual as well as business, and here is the slide with the individual provisions. If something wasn't clear, please feel free to reach out and let us know, and we'll be happy to discuss with you. And now it's time for some Q&A.
Very good.
So one of the questions here in the chat box that I do see, and which I think we have had discussions already almost as soon as the bill came out, Wayne, was what if I'm renting a building? I am a manufacturer and I'm renting a building and I'm in a long-term contract. I'm carrying that building, but how do I get the new deduction on my manufacturing facility? Does somebody get a deduction on the manufacturing facility, right?
Well, unfortunately, we'd be looking for bonus depreciation for ourselves, and we cannot take that unless we actually own the building. So if we're renting and we're a tenant, unfortunately, no, we would not get any benefit from that.
And I think it remains to be seen, but a very common structure for us is that we always want to separate the manufacturing activity from the rental real estate. There's tax reasons, there's liability reasons, there's generational wealth planning issues with maybe slightly different ownership within the family and so forth. And really the new deduction, at least the knowledge that we have right now, does not contemplate this type of setup.
Correct. Correct. Yeah. And even things like leasehold improvements, if that's made within the company. Yeah. Okay. How that factors in.
And then another question, and I mean, thank God for software because AMT is just the thing that I wait for to be abolished. But how does the SALT cap and AMT come into play? Does AMT affect your ability to claim the state and local taxes? I remember that.
Yeah. So. Yeah, unfortunately, the new SALT $40,000 limit is subject to AMT preference item, so it is not deductible for AMT. So on our 6251, we'll have an add back for that in order to get to AMT base income, which we'll calculate the AMT off of. And compare that to regular tax.
And we already have this faster phase out, right, from 25% to 50%. So even though we have the higher exemptions, it seems like we're going to fly through them fairly quickly.
Yeah. So AMT may start coming back into play as well. Yeah.
Well, thinking of AMT, I think the good news that we saw about that was that at least the bonus depreciation, both on qualified production property and traditional bonus depreciation that we talked about, at least that is not a preference item. You already addressed that it is a preference item for state and local tax, but at least it's not a preference item for AMT.
Right. All right, another question here. Eliana, can we change the way we get paid to maximize the tip deduction? That's a great question.
So I think we already talked about that. I would say definitely start thinking outside of the box. If you're in an industry where you consistently or routinely receive tips, As we said, beauty services was probably the first thing that would have come to mind for me, where we frequently tip at different salons. So definitely, if you don't have a structured pay, think about it. And also, it's important to note that if you're self-employed, then you're reporting everything on Schedule C. So as so many people are, your net income from that business activity on Schedule C must be at least $25,000 in order to claim the tip deduction of $25,000.
Okay.
Yeah.
Very good. Here's a 1202, actually. My company stock is a qualified small business stock. It was issued in 2015. How much capital gain can I exclude under the new regime, new law here?
That's a great question.
Yeah.
Unfortunately, the new rules apply only for newly issued stock, but there's maybe a couple of distinctions and some planning opportunities that I think need to be considered going forward. The stock has to be newly issued stock, but that does not mean that the company needs to be a newly formed company. So that may be a silver lining if you're considering admitting any new shareholders or sort of trying to attract additional capital investment in an entity that qualifies as small business stock and you're going to be issuing new stock. So your entity may be older, but your stock is newer, if that makes sense. So that would be really helpful. And then with care and analysis, maybe we'll consider whether or not any flow-through entities can efficiently be converted or reconstituted to achieve 1202 status as corporations, so that we can take advantage of the new rules.
Right. Okay.
Yeah. So with that, we are almost out of time. Do we want to share some final thoughts with you?
Yeah, so if you submitted a question we did not get answered, we'll follow up with you via email here very shortly. Of course, reach out to your HLB team for questions or guidance on applicability to your specific situation. Materials will be posted on our YouTube channel. Once they're posted, you'll receive an email with a link to that content. And we want to thank you so much. We appreciate you, and thank you for attending today. And we appreciate the opportunity to continue to serve you. On behalf of Ileana and myself, have a great afternoon. Thank you so much.
Thank you.